Hey, what's up everybody? It's Rusty Paap with Paap Properties of Intero Real Estate Services, and I want to talk a little bit about interest rates today because it's on everybody's mind. I have an interesting perspective on rates because I did loans and sold real estate for the first 10 years of my career, and over the 21 years that I've been in the business in general, I've always heard rates are going up, rates are going up, rates are going up, and that's what the experts continued to say, and literally for 20 years, they didn't. But then this last 6 months or so, they've really gone up quite a bit, and it's made a huge impact on our real estate market. I think it's lost on a lot of people how much of an impact the interest rates can make when we're talking about $1.5 or $2 million or $3 million properties. So I wanted to put that in perspective for this video. Let's just say that you bought a house in March for $1.7 million. With the interest rate that you could have obtained in March, that house payment with a 20% down would have been around $5,900. That's not including taxes and insurance. Now, if you were to buy that same house today, it might actually only cost $1.3 million. But at today's rates, with 20% down, it's actually $6,500 a month. So it's more expensive now on a monthly basis, even though the houses may in some cases be $200,000 or $300,000 or $400,000 less than they were 6 months ago. And that's kind of crazy to wrap your mind around because the difference in down payment is actually about $80,000. So yes, you pay $80,000 less down today, but your monthly mortgage payment is actually significantly more. It's just an interesting perspective. And then the question becomes, how do we combat? One of the things that we're seeing in the market, right, is that buyers with these higher interest rates want to pay, say, $100,000 less than maybe they would have paid a month ago for a house because the payment has increased by that number because of rates. And similarly, sellers don't want to magically say, oh, my house is worth $100,000 less in a month, right? So one of the ways that we can combat that is if a buyer is willing to pay the extra $100,000, but then at the same time, the seller's willing to credit back, say, $25,000 of that, the buyer can apply that credit to paying points to their mortgage lender, which would bring their interest rate down significantly enough to where the payment is the same or less than it would have been at the lower price. So you can have the best of both worlds. And that's something that actually is a very viable option in order to kind of make buyers and sellers meet in the middle. It's kind of confusing. The math on that might not be real easy to understand from a quick video like this, but if you want to reach out to me, I'd be happy to explain in a little bit better detail. The long and short of it is that you could actually have basically the same price of a house from a buyer standpoint, even though the seller's getting more money, where they're both kind of winning. Something to think about if you're an agent or if you're a buyer, and especially